we'll dig a little bit deeper here into our operating profit options. If you remember, we just looked at EBITDA, earnings before interest, tax, depreciation, and amortization. And we said to get from there to our EBIT, we needed to subtract non-cash deductions, or what is sometimes referred to as NCDs. Non-cash deductions can be in the form of depreciation, amortization, or depletion. And we'll dive into these in a little more detail in just a moment. But we want to be very clear here. Depreciation is for tangible assets. Amortization is for intangible assets. And depletion is for non-renewable resources. So any given organization may have all three categories, or two, or one, or none. It depends on what assets we have and how old the assets are. We may have fully depreciated the assets. We may not have any intangibles. So do not be surprised if you don't see all three or you see one or two. It very much depends on the industry, the age of the business, and the accounting choices that the organization has made. And we'll dive a little deeper into that in just a moment. So our earnings before interest, tax, depreciation, and amortization, also known as our operating profit, less any non-cash deductions that are listed, will get us to our earnings before interest and tax. So let's take a look at these non-cash deductions and dive a little deeper. We have, as we stated, three different forms, potentially, for non-cash deductions. Depreciation, which is defined as the scheduled reduction in value of a tangible asset, a building, a piece of equipment, a vehicle, a vessel, are depreciated. When we acquire the assets, we decide which method we're going to use, and we'll look at these in a little more detail in a moment. We make that statement, we list the asset on the balance sheet. Each period, and we'll make it simple, each year, we will calculate, based on the formula, the exact amount of depreciation expense that goes on the income statement, and that accumulates on the balance sheet. Why? Great question. Because our non-cash deductions are the accounting way to recapture the investment we made in the assets. The way accounting is set up, and it's consistent in most countries with the tax laws, we cannot invest in a building for $25 million and take that as a business expense in the same year. Remember, we talked previously about the matching principle in accounting. The matching principle here says if we acquire major assets, accounting requires us to match the expense of that, or acknowledging the annualized value over its useful life. So we'll take a simple example. A piece of equipment, accounting may say it has a 15-year useful life. That means we, according to accounting anyway, are going to use that asset for 15 years. So we are required to divide the original cost by 15, and each year take 1/15 of that total investment as an expense. Now that may sound a little confusing at first, but if you stay constant with the matching principle, you'll understand. Accounting says, let's match the reduction in value of this asset with how long we're going to use it. So if the asset cost $150,000, has a 15-year useful life, that's $10,000 per year in expense. We get to count on the income statement to reduce the income, therefore reduce the tax, to show over the 15 years how we have used up the value. Now, how does that link to the balance sheet? Remember, the balance sheet shows that we paid $150,000 for that asset. Each year, we look at the expense on the income statement. In this case, it was $10,000. And after 1 year, the $150,000 asset is worth $140,000. Year 2, we have another $10,000 expense on the income statement, gets accumulated or added up on the balance sheet. There was our $150,000 original investment minus 2 years of $10,000 expense. That's $20,000. The net book value of the asset is down to $130,000. So if we took this out the full 15 years, at the end of the 15th year, the asset would be depreciated to zero for accounting purposes. That does not mean the asset has no value. It may or may not. That would depend on the asset. But that's the concept behind depreciation, to allow us to recapture the investment in assets over the number of years in which we're going to use it. And we'll look at some specific numbered examples later. So that's for tangible assets. And this is by far the most common form of non-cash deductions. Most organizations have some assets to be depreciated. Amortization is much less common. Amortization is the way we recapture or recover our investment in an intangible asset. Patent, trademark, covenant not to compete, customer list, etc. There may be a particular process that we acquire from another organization. We paid $1 million for it. We don't know how long that's going to add value. And here's a major difference between amortization and depreciation. Depreciation, the day we acquire the asset, we determine the depreciation method, and there are 4 of them. That gives us a simple formula, and we know in advance the annual expense. Completely different when it comes to intangible assets. An intangible asset, we cannot accurately predict, for accounting purposes, how much value, if any, will be lost each year. So this is why, if we have an intangible asset, we need to do what's called an impairment test. After we've acquired the asset, each year, we must have an independent validation that the intangible asset, again, like a trademark or a customer list, has or has not lost any value. If it has, that amount is expensed on the income statement and accumulated on the balance sheet against that intangible asset. So where the depreciation is scheduled, predictable, and frequently the same every period, with intangible assets, we may have no loss of value for a few years, and then a significant or even a complete loss of value, expensed on the income statement and accumulated on the balance sheet in a given year. So it's much less common to have intangible assets and much less consistent when we amortize an expense versus the tangible depreciation. Third category is depletion. Now, depletion is for a very select group of assets. In fact, there's a separate section under both generally accepted accounting principles and International Financial Reporting Standards, IFRS, for depletion. It's only applied against non-renewable natural resources. So, oil, gas, coal, these types of resources are extracted from the ground and are not to be replaced. A forest, even if we cut trees, can be regrown, so they are not depleted. So if we're in one of those extraction industries where we have reserves, we're producing from those reserves at the beginning of production, and in many cases pre-production, we have calculated or estimated the entire volume of product. Again, oil, gas, coal, gold. And as we extract those units, whether they're cubic feet or barrels or tons, that amount is expensed on the income statement and accumulated on the balance sheet. Here's the concept. Think of a 1 liter bottle of water. That's our reserve. There is a pretty specific quantity within that vessel, within that reserve. As we drink or consume or extract that liquid, we are depleting it. If we have calculated properly, when we have depleted the entire reserve, in other words, when that 1 liter bottle is empty, we will have recaptured 100% of our capital invested in that reserve, expensed it on the income statement, accumulated on the balance sheet to offset that capital. So depreciation is for tangible assets, amortization is for intangible assets, and depletion is for our non-renewable resources.